You know what, it feels like that. And the Nifty has now covered 19,000, 20,000, half of that distance. It's taken, as I said, 10 days to move from 19,000 to 19,500. My sense is we are not just stopping at 20,000. You know, this is a market which is sensing something else, the kind of FPI money that we are getting, the kind of domestic money that we are getting, and most importantly, the kind of earnings growth that we are going to go through now from here on. It's visible in the economic numbers. I think it will be visible in the micro numbers from here on. Nifty IT, as you said, 4.7% for the week, out of which I think 3.5% came today itself in the Nifty IT. And the other big factor this week was the big decline in dollar. And I think the fact that we have broken 100 on the dollar index opens up a plethora of money coming into India. And you know, I was reading Chris Wood's note, the Friday note that he writes about India versus China and how India has really outperformed China. And you know, Samir was here and he was making the point that that's going to continue. So I think that's really the big risk on rally factor. I want to give some time to IT because, you know, we're talking about this in the morning. And I recently interviewed Ridham Desai last month, and I asked him this question on IT, and one point which he made which really stood with me is, and it really gave me a line, is that the point of maximum uncertainty is also the point of maximum returns. And if you look at what's happened in IT, after last quarter's howler from Infosys, IT has actually given the highest returns. You know, you go back and check, you know, you're getting surprised by today's move. Go back and see the 3-month moves. Most of the IT stocks actually are at almost 52-week high now, you know, especially in mid-cap IT, Coforge, LTTS, Persistent Systems, Tech Mahindra, HCL Tech, I think another 5-6% it will hit 52-week high. So I think what's happening here, there are 2-3 factors why, you know, you're seeing this kind of a rally. Market is betting on 2 factors. What are those 2 factors? Factor number 1 is that have we already seen the worst of the earnings last quarter? And secondly, interest rate pause by the US Fed. And I think that is a bigger factor in terms of the recent rally, because what it does is, you'll remember the post-COVID rally. A lot of this rally was because the work from home culture had picked up and a lot of companies had saved costs, but also because the IT valuations had ballooned. 17-18 times, which used to be the normal, became 30 times for IT companies. After that, we saw that big rate hike by Fed and the valuations came crunching down. Infosys bottomed out at 17 times. Now, I'm not saying we'll go back to 30 times, but even if we have to go back to say 21, 22 times, which has been the recent average of last 5 years for IT companies, that itself means that, you know, this rally has legs to go. And I think that's what the street is trying to price in. Numbers were very bad. Make no mistake about that. And the commentary also was not that great. The companies didn't scale down the guidance. That was positive. But I think the market believes the worst is over and valuations will pick up from here.
Okay. And Nimesh, what are the